Welcome to another episode of Life in Focus, where we dive into the world of real estate, the real-life experiences and insights from our guests. I'm your host, Ben Tate, and today I'm joined by John Robbart from Renovo Financial.
Yep.
And we're going to dive into some of the different loan programs that they offer. This is going to be especially important for all the real estate investors and entrepreneurs out there that are looking for funding for their next project. Obviously, funding is the cornerstone of making that project a reality. So we have some good nuggets today on this episode. But before we dive into everything, John, want to give us a quick intro on yourself and how you got into the business?
Yeah, thank you. So my name is John Robbart. A lot of people know me as Hard Money Johnny on Instagram. Mm-hmm. I want to preface by saying that this is not going to be a boring conversation about what loan to value and what rate. And I think there's going to be a little bit more substance to the conversation. So I want to start with that. A little bit about me. I've been in private lending for 5 years. Year to date, we're at probably 85-ish million on the year in loan volume. The lion's share of that is in the Tampa Bay area. The rest of that is, in other parts of Florida, Jacksonville, Miami, Panhandle. I got into private lending through a good friend who is actually now the top producer of the company I work at.
There you go.
We were working in a nightclub together in San Diego and did that I eventually transitioned and went to work at the company that he was working at in San Diego. One of his clients was a partner at a hard money company, and it took off for him, and he was killing it. And I saw his success, and I was like, wow, I want to do some of that. Sick of going to bed at 4 o'clock in the morning, tenant bar. So, eventually I joined him. He actually happened to be from Boston, where I'm from as well. And I moved back there right before COVID. Mm-hmm. So February 2020, moved back to Boston with my girlfriend and dog. And 2-3 weeks later, I think you know what happened.
Yeah.
We were locked in our homes. It was a little bit ridiculous.
Kind of perfect time for a career change, especially in real estate.
Yeah, I mean, I was kind of already in it, but at that time, like the career got put on pause because of what was happening in the economy and the capital markets world. Like lending just wasn't a thing. Right. So we pivoted. We're both entrepreneurial guys. We started a mask business. We were selling KN95 masks, which if you know me outside of here, I'm about as anti-masks as it gets. So it's kind of ironic that was what we were doing, but we're trying to make a buck. So did that for a bit. That lasted maybe a month or two, and then eventually pivoted back into private lending. I started my own independent broker business because I knew the ins and outs of how it worked.
Sure.
As I was starting that, Paul, my partner and friend, got approached by Renovo, who is a lender based out of Chicago.
Okay.
And at the time, their whole thing was, hey, let's be local and let's just be the foremost expert on this area. And they, at that point in their business, they realized, hey, we should really take this and explore some new markets and kind of grow this. So the first hire was somebody in Texas, and then the second was my friend Paul in Massachusetts. So as he was getting approached, he was telling me all the great things that they were offering him, and what their plans were, and why he felt really good about it. And he was like, just bear with me. Let me get my feet under me, and then as soon as there's room, I will bring you in. I promise.
Yeah.
And true to his word, he did offer me something. Yeah. It was maybe 2 or 3 months into it.
Sure.
And at the time, I was so excited about having my own business that I was like, I don't
need it.
I kind of like the freedom of what I have. I didn't have a boss. I was my own business. Yeah, it's kind of like being a real estate agent. You can do what you want. Like you produce as much as you want or as little. It's your world.
Yeah.
So I was doing that, and so the end of 2021 rolls around, and I did about 38 million, which when you're on your own is a pretty decent amount of loan volume. The following February, so this is now February of 22, he did 31 million in a month.
Jeez.
And I was like, okay,
all right,
I'm doing something wrong here. I'm missing something, right? And I knew what they had and what they were doing was really buttoned up and really well done, but I didn't want to keep living in Boston. Part of that was COVID related, but part of that was if I do Renovo, they want you to be local. This is their model. And I was a little bit resistant to that idea at first, and now I'm not resistant to it at all, for obvious reasons. Yeah. But I was like, he's already got a lot of the really good people here. Like, I want my own thing. I want to build my own. I want to plant my own flag. I want to build my own business within a business. And I had done a bodybuilding show in Boca. This is May of 22.
Okay.
Oh, no, May of 21, excuse me. May of 21, and then we turned it into a vacation. So we went to Orlando, we went to Tampa, and I remember driving through some of the streets and, in St. Pete and North Hyde Park and West Tampa and, where Taylor, my fiance, and I come from, like, you don't just drive down a street and there's like a vacant lot. Like, that's just not a thing.
Right,
like people are listening to this and they're from Florida. They're like, why not?
Yeah.
That's not a thing.
Yeah, Northeast is nothing. You
That
go up.
doesn't exist, man. Like,
Yeah.
maybe out in the sticks, but then there's loads of trees everywhere, right?
Yeah.
And I was like, there is so much opportunity here. Like, I couldn't believe it. And there were so many distressed houses in areas that did not feel dangerous. And I'm like, there's just unbelievable amounts of opportunity. Like, we have to move here. Like, we have to. And there was a house we were considering buying in Delray Beach, and that ended up not working out. I'm not going to bore everyone with that story, but that's how we got to Florida. So we moved here in April of 2022. Put an offer in on a house, sight unseen, just Google Maps.
That's what I did when I came to St. Pete.
Yeah. I mean, it's like at the time.
You got time to pull out once you see it, so
Exactly.
it's not as scary as it sounds. But
Exactly, yeah. So we did that, and then a couple months later, finalized an offer with Renovo and joined the team in July of 2022, and
haven't looked back.
Been here ever since.
Yeah, that's awesome. I think you made the right decision too. Obviously, everything works out for a reason, anyways. But I lived in Delray Beach. That's where I lived previously to moving here.
Okay.
And it's awesome over there. But there's something about this area that just feels like there's more opportunity. It's more collaborative, more community based. Over in, I think on the east coast of Florida, it's really the Florida version of the Northeast. Right. And the Northeast is very segregated, even between the towns. There's so much pride between each city or each borough, whatever the case is. And not to say there's not pride here in Tampa, but I think it's just more community-based pride.
I agree.
And so it's like, hey, are you an entrepreneur? Are you in real estate? Are you in whatever you are in?
Right.
Let's, boost each other up. Let's work together. Let's, what are you doing that's working? I want to, piggyback on that. So, I mean, I'm a little biased because I spent some childhood here as well.
Sure.
But just, professionally, I've had the most fun in my life professionally here in Tampa.
On this
area.
side.
Absolutely.
I will say that I've noticed some, use the word segregation. I mean, I think there's some, like a distinction between people who live in the city of Tampa and the city of St. Pete.
Oh, absolutely.
And there's definitely this divide, and it's so funny because in Boston, it's a lot like that, where it's like, I'm from this town, you're from this town, like my family grew up here, your family grew up here, like it's totally different. But in like, because I'm from there, I understand that and get it. But like down here, it's like what? They're both great cities. Like,
exactly.
It's like I forgot that that's a thing, and I'm like, oh, well, I guess,
It's funny because that's how you know the city is gentrifying and growing, because that is a thing.
Right.
Because 15 years ago that wasn't a thing. Like nobody from St. Pete would be like, oh, I'm from St. Pete. It'd be like, oh, I'm from the Tampa Bay area, right? They would be, even if you lived in St. Pete, if you traveled, they would say, where do you live? You would say, I'm from Tampa or Tampa Bay, right? Technically, St. Pete is Tampa Bay because the bay connects both sides,
right?
But that's how you know it's growing. But I think both cities are working nicely off each other. I think obviously St. Pete with the restaurants and the family vibe and all that good stuff, and Tampa's still like where business gets done. It's still the downtown area. You've got the airports, you got the Buck Stadium. I mean, it's still the Mecca. So that's all well and good. But
both cities are seeing huge commercial development. And I think that's where a lot of the draw is. So
absolutely. In my opinion, it's the perfect midpoint in the state.
Yes.
I think different cities in the state of Florida have different benefits, right? But Tampa, I mean, you're right in the middle of either Orlando or Southwest Florida that's growing. You're never more than 4 hours away from the east coast of Florida. So to me, it's just very accessible. And obviously with the high-speed, train that's finished in Orlando that's coming to Tampa next, it's going to really shrink the state. I mean, to think that you can technically live in Tampa and really, if you really wanted to, work in West Palm Beach or Miami and just take the train to and from
every day,
it's a real thing,
right?
It's like living in New York City, working in DC, or vice versa. So it's kind of cool. Kind of shrinks the states, opens opportunities. But getting back to on the lending side of things, because of social media, because really exacerbated from COVID, with lower interest rates, there was opportunities late. I would say at the end of 2020 through arguably the end of 2021, we really had 12 to maybe 15 months of some real opportunity with low interest rates. Some good.
I'll go even maybe mid 2022 with that. But sure,
absolutely. And so with that comes everyone trying to make money, teaching courses, doing masterminds, gurus, and a slew of private capital and private equity companies, whatever the case is, doing Instagram marketing, stuff like that. So it's hard for people that want to dip their toes into this kind of stuff to really differentiate the good quality lenders from those that are just trying to get a buck type thing and may not be a good fit for them, especially long term. Everyone should be thinking about these things long term, right?
Right.
And so I think far too often we get caught up in interest rates or points up front. It's like, dude, just build the relationship. And if you plan to do this for 2, 5, 10, 20 years, I'm telling you those terms are going to get better. People are going to be knocking down your door to do deals, right? So how does Renovo kind of differentiate themselves in the Tampa area, specifically from some of the other competitors that, are on some level saying the same thing to potential clients, but maybe don't back it up as you guys do?
Yeah, well, Ben, I had a lot of clever things to say, but you just said a lot of them for me. So I'll ask you to not keep doing that. Yeah. But no, in all seriousness, yeah, I mean, it's a relationship business, right? The huge benefit that we have as a private lending company is that the people that we work with are not leaving to go do something else tomorrow, right? Like, this is their business. Their business is finding distressed homes or finding opportunistic land, or it's finding mismanaged multifamily or building a rental portfolio and then looking for capital to do that. Now, if there's one lender that can do all those things, and amazing. And yes, that is what we do, right? I don't mean to sound totally self-serving, but the basis of our business is those things. Now, to your point, like, there are a lot of lenders that maybe they're capitalized differently or one of those things. A few of the things that I think make us very different from other lenders is first and foremost being local, living and understanding the area. So I serve clients from here to Naples. We've done business in some of the other markets, Miami, Jacksonville, Orlando. I've got a few people I work with up in Santa Rosa Beach, Panhandle area. But to your point, like, I think that's the first thing, because I tell you this, like, people call me sometimes with a deal in an area that I hear the numbers and sometimes I'm like, man, that doesn't sound right. Like, I really need to look at that before I respond, but I'm like, something's off about that, right? And I think too often there are loan officers to these companies. I mean, it's no secret we're in a commission-based world. Some of these loan officers, some of these companies are just like, oh yeah, great, that's a deal. Sign it up. And they start putting it in the system and sending out the term sheet and get the customer to sign, and they can't get the customer to pay for the appraisal, and there's no like slowing down and there's no partnership in that. It's like, this guy's like, I'm making a buck. Right. And the customer feels good about it, and maybe
just because they got a loan closed or whatever.
Maybe they're a 10+ guy. And when I say 10+ guy, I mean 10 deal a year guy or a 20 deal a year guy. But sometimes they miss things, or sometimes they're seeing things that they think are a certain way and they're missing that. So part of our value proposition, I guess, is maybe the word I'm looking for, is we want to be a partner to people. And the way that we do that is by looking at things and thinking about things and fleshing out the idea before committing to a loan. Another thing that I think makes us very different is our asset management. And for those of you listening who don't know what I mean when I say asset management, is the way that the draws are done. Right, you're borrowing money to buy the house, and you're borrowing money to renovate or to build. The way that money's dispersed is done totally differently. So there's a lot of lending companies that are out there that require, when I say require, their investors in their lending business require that they use a third-party draw inspection company. And then sometimes the way that money gets dispersed is the investor has to have a say in it before the money goes out.
Let me ask you, why would they request that? Like, what's the biggest benefit to that?
Sure. Without going too deep into the way that lending companies are structured, I don't want to bore everyone with this, but if you're a lending company, the way that your business is set up is you're trading loans to a larger organization, and that larger organization is trading that loan off in a larger tranche, and each of these guys, because they have money in the deal, you get to set some of the rules. And in order to standardize things and to make things simpler,
the third-party unbiased person, they
say, hey, these are approved companies for draws. You can use any of these ones. And I think everyone in this business is well-intentioned, but the more that you remove the personal component of it, the
better checks and balances inherently.
Yeah, but when you remove the personal component, you can still have the checks and balances, but when you remove the personal component of it and you add all these third-party entities in the mix, the process can tend to get a little sloppy.
Oh, sure.
Right. Yeah. And so if you have a third-party inspection guy and that guy maybe doesn't care, and then the investor's got other draws that he has to review and approve, and that maybe that guy's not in a rush.
Right.
You, Ben, as the developer, can sometimes be waiting for upwards of a week longer
for all these parties to
sign off and to check boxes and for them to feel good, and that in turn can result in kind of a sloppier process. So what we've done at Renovo is we've minimized that, and we've got an in-house asset manager. He's local. He lives in Tampa. For projects that are a little bit further away, we have other methods of getting this done, but ultimately he's the decision maker, and he has to stand behind the approvals that he makes for how much money he's releasing. So this is a big component of this, because if you're borrowing money, and I have customers who don't take a draw the entire project. Some customers who take a draw every other week. Yeah. Right. It's up to you. Right. There's a small fee you pay for the service, but ultimately, like, you want to be able to have access to that money. Right. And some, for us, like, our pledge is that within 24 to 48 hours of the inspection, you should have the funds in your account. Yeah.
Pretty quick.
Yeah. And then the last thing that I think the big key differentiator is that we're also a servicing company. We service all of our own loans, and you might say, well, like, why does that matter? And what is servicing? Servicing is the entity that keeps track of the payments and keeps track of the balance. And when it's time for a payoff, they're the ones that issue the payoff. And again, having that as part of your business versus outsourcing that to a third-party entity, again, it's all about, like, what's the experience like? And we're hyper focused on, like, making sure that from the minute that you meet me to the minute that you pay off your loan is ideally a really smooth experience.
Yeah, no, that makes a big difference too. If there's any issues, if there's not any issues, calling one person. And also too, sometimes when you call the number on these advertisements for lenders, you might get somebody in Boston or California or Washington who's just trying to approve you on the surface level details, which again are still important for approval process, but they can't get in the car and drive down and look at the site that you're talking to them about. Right.
Yes.
And so I think,
or even know that area.
Or even know that area exactly. Right. And real estate is not black and white, as much as people that are learning it want it to be black and white for their learning, understanding purposes. Sure. So having a lender that's local, there's nuance to it. You'd be like, oh, you know what? That doesn't look exactly 300 on paper, but I can see around here this is easily 400 or whatever the case is.
Right. And by the way, after this street, things change dramatically, and I know that because I go to that area at least every other week.
Yep. So that makes a huge difference. So for people that don't know, kind of a boring question, but for people that don't understand the difference, they say, hey, I want to get into investing. I need to obviously leverage some capital. What's the difference between going the hard money route as opposed to going maybe a conventional loan for an investment?
Yeah, so I get that question a lot, and I don't want to speak for banks because many banks make many of their own rules. They portfolio the loans, meaning they keep them in house, and they're not trading the paper to anyone. So they make their own rules, and they can do what they want. Up in the Northeast, like, some of the banks are more bullish on distressed projects, and in other parts of the country, they're not interested at all. So I don't even want to address what banks are doing. But the common theme with some banks, and it's more common than it is with us, is that they're not interested in projects that have distress. They're only interested in things that are totally renovated or livable, or they'll pass inspections, or the appraiser won't mark that there's a lot of deferred maintenance. Yeah. Correct. Yeah. So that's the main reason that someone would go with an institutional private lender, hard money lender, whatever term you want to use, versus going to a bank.
Gotcha. So a little bit more streamlined. You might. Obviously, I think everyone assumes that the cost is more for hard money. Is that pretty standard from what you've seen?
Yeah. So, I think another thing that and I always like giving people this analogy because I think it helps people better understand it, right? So there's like a spectrum of finance. On one end of the spectrum, you've got a local bank, right? I'm gonna use DFCU because I know that they'll do rehab projects. DFCU, local bank here in Tampa. They have branches throughout the country, but I know they have a decent presence here. So DFCU will beat me 10 out of 10 times on rate. And for that they require certain things, right? So they maybe want tax returns, they want a certain amount of things. Now on the opposite end of the spectrum, there's a truly asset-based lender, and the asset-based lender cares that the person who's requesting the loan has a pulse, that they have the money to put down, and that they like where the project is. But besides that, there's not a ton of due diligence on the person.
Sure. The asset's like the main collateral, essentially.
Yeah. Like, do we feel good enough about the deal, right? Like, Never mind if the guy can do it.
Right.
Right. And then there's this happy medium. Oh, and sorry, to clarify, the guy that's on this end of the spectrum, very expensive.
Sure.
Very expensive.
Right.
Right. Like
high risk.
Top end of the cost of capital is this, and bottom end of the cost of capital is the bank. But the bank wants lots of stuff and might take a long time.
Sure.
Right. So there's like, what we offer is like really this happy medium. Right. Like, yes, we are more expensive than the bank. Right. Like, spoiler alert.
Yeah.
We're definitely less expensive than the guy who's solely asset based.
Yep.
And in line with that is the items that we're going to request is we're going to ask for some of the things the bank asked for, not all of them, and we're going to do more due diligence than the asset based guys. But that's kind of where we stand.
Yep.
So
makes sense. So let's talk about some of the main loan programs that Renovo offers, right?
Sure.
From my understanding, you got the rental loan options, you have the rehab loan options, new construction, and multifamily. So let's start with rehab. What's kind of the bread and butter or the standard kind of project setup that you see for that loan program?
Sure, yeah. So I'll actually simplify that even further. So there's really 3 offerings, right? There's rehab, right? So adding value to a structure that's existing, and we'll entertain projects anywhere from 1 to 100 units.
Okay.
So that's one. We're talking 12 to 24 month term. On the second option that we offer there is a rental program. So the rental program is a 30-year term. Okay. And this is for projects that are stabilized.
Gotcha.
Same unit count, 1 to 100. And that's 30-year term, 30-year
purchase stabilized, correct?
Purchase or refinance, right? So think about it. You do the first project,
Yeah.
whether it's a 2-unit project here in St. Pete or a 35 unit in Sarasota, right? Like, we'll do both of those. The terms are going to be a little bit different, but we would offer the purchase and renovation money on the front end, and once it's stabilized and done, we'll refinance it on the back end, right? So those are the first 2 things, and then the third thing, and this is obviously very interesting to people in here, given the opportunity to access land and to do those types of deals, is new construction.
Sure.
And we see a lot of that. So that's typically either 1 to 4 unit buildings, or for more sophisticated investors and builders and developers, is like we'll do like townhome communities, or it's a plot of land and it's vertical ready. You want to do 10 houses, right? We have a package of 12 that we're getting ready to close on, that we're offering vertical construction dollars for this gentleman and his business to build 12 houses.
Gotcha.
Yeah.
So let me ask, on the rehab side of things, are most people coming to you for just the capital for that rehab? Are they expected to basically have ownership of that property already? Are they packaging, acquisition and rehab, or what are you seeing with that?
Yeah, the lion's share of them are they're looking for money to buy the property and money to renovate.
Okay.
So we offer both. How much money are we offering toward the purchase varies wildly depending on, first and foremost, what has this person done?
Sure.
What does their experience look like? And what type of asset is it?
Right.
Right.
Are you guys relying heavily on the appraisal in those situations for what they're saying that the dirt mainly is worth, or you guys what's how do you guys look at that from a risk evaluation standpoint?
Yeah. We evaluate what they're buying it for, and then what is it worth.
Yeah.
Both of those.
Yeah.
A lot of it is like a lot of this is kind of experience focused, right?
Gotcha.
So is it first, someone
So you're
who's
still
done
betting on the investor themselves almost more than the asset itself.
Again, going back to my analogy, it's like it is the happy medium. It's
Sure.
the person who's in the middle who's got he's got some money in the bank. Maybe he doesn't have a consistent 2 years of tax returns, but he's got some reserves.
Yeah.
He's got money to put down and can float himself through the project. But it's also not solely like the project, right? It's both.
Gotcha.
Yeah.
No, that makes sense.
And going back to my when I was giving you the offering there, it's like 1 to 100 units. Like, we have a thing where it's like, does it pass the red face test?
Yeah.
Right? Like, can you say this without getting a red face? Like,
Yeah.
first time investor, 80 unit building. Like, no, man.
Yeah.
Somebody doing 80 units has lots of experience.
Sure.
They have done. They're a real multifamily operator.
Sure.
They've bought properties, they've stabilized them, they've sold them, right? Or they're
Yeah.
keeping them as long-term investments.
So a big question for most people when they're trying to get into investments is, how much money do I need to get into an investment, right? And I always say that's an important question, because there's no point of saving if you don't have a goal to save towards, right? So what are we saving for? A lot of people are like, oh, I'm just saving money. It's like, for what? So let's say you want to get into a rehab situation. Let's just use that as an example. And let's say the property costs $300,000. Let's say the rehab is going to cost you, let's just say $100,000, right? So acquisition, closing cost, and rehab is going to be $400 all in. What kind of money would they need to bring to the table to have a good chance of approval, assuming that work history, reserves, good credit are not an issue?
Right. Yeah.
Again, they have no history of investing.
Right. Yeah.
Se.
So I'll just answer the question broadly. The number that we're looking for in terms of a reserve is, we want to make sure that you have enough money to put down, and that number that you put down is based on how many deals you've done. Gotcha. So is it 1? Is it 0? Is it, well, I haven't done a rehab, but I own a rental. I've done some work to that. Like, sure. There's a lot of nuance there, so I can't give you like an exact number. Sure. You got to have the money to put down and the closing costs. Above and beyond that, we look for 12.5% of the loan amount post-close. Gotcha. Post-close is just a fancy way of saying after you put the down payment, pay the closing costs, and whatever thing, do you have 12.5% of the loan amount in cash?
Right. Because assuming that assumes worst case scenario. From an investor standpoint, if it takes you more than, let's say, 12 months to finish the deal. Right?
Yeah, I mean, a common thing you'll see in this industry is you'll see lenders say, we want to make sure you have 6 months reserves plus 10% of the budget. That's a very common one that you'll see.
Yeah. Which is probably close to 12.5% or whatever.
It's close to that. Yeah. Maybe 12.5 is a little bit more. I don't know. But if you're looking at several deals, the percentage thing makes it way easier to calculate.
Absolutely.
At least for me, it's like, okay,
you can move them, qualify in and out quicker.
Right. And then also it's like, is it 6%, 6 months of payments based on the drawn funds or the undrawn funds? Like, how are you doing that math? So for us, it's like 12.5% of loan out. You gotta have that.
Post-close.
Post-close.
Yep. Yeah. So that's good. And then for down payment, is that for closer to 30%? Is it 25%? I know it's going to be a little bit more because it's an investment loan, right?
Yeah, sure. No, well, it ranges. And I think part of the value that a lot of people see in working with a private lender versus a more traditional financial institution would be that, typically you get more leverage.
Sure.
Right. And that, I think this is one of the value propositions above the stuff I said earlier for builders is, a builder, a reputable and established spec builder, I'd be able to go out and get a line with some of the local banks.
Sure.
But we offer more leverage than they do and more speed. To answer your question about how much down, it ranges from 10% to in some cases 30, in some cases it's 20. I mean, 15 I think is pretty common.
Yeah.
Sometimes it's 10% of the total cost. It just kind of depends.
Gotcha. So obviously it can vary, but for those of you listening out there, if you're looking at a deal around the same high level numbers that we just spoke about, if you're in the ballpark of having 30% of that deal in reserves in pocket, it's probably enough to start the conversation with somebody like you. Right?
Yeah,
at least start the conversation and see how far off you are.
Totally.
We're at least 6 months away, or we're a couple months away, or we have plenty.
And thank you for distilling that down a little bit more simply, right? 30% of the whole project, right? If you think about that number, right? So you're buying it for $300, it's $100 in rehab, you're all in for $400. Yeah, if you have 30% of $400, it's probably enough. Yeah, it's a great place to start.
Yeah, absolutely. Right. So sometimes people are too embarrassed to have this conversation, so it's like give them an idea of where you got to be to at least say, hey, you're in the gym.
Right.
So
yeah,
let's see where we're at type of thing.
Totally.
So let's talk about bridge loans. Can you explain that, a bridge to permanent loan?
Sure, yeah. So bridge is a term in the industry that is a fancy way of saying temporary. Right, I'm in between these two pieces of land, and I just need to get to the other side. Like that is the bridge, right? So I'm in this situation, right? The house is distressed, so I need some time to get to a more permanent situation. That's a bridge loan.
Gotcha.
To distill that even simpler, it's a bridge loan is just a fancy way of saying a short-term loan that's typically interest only. You're looking at 12, 18, in some cases 24 months.
Gotcha. Is that more common, obviously, for a larger project? That's not going to be for a one unit, I mean, I know it can be technically, but do you see that very often, or is it typically for the multifamily deals? Very
common to do it on single family or multifamily, right? So anything that has a value add component, whether it's a new build or a single family rehab or a multifamily stabilization play, like any of those are going to be bridge, and bridge oftentimes, check with your local lender if you're not working with me, is interest only.
Gotcha. Right. And in most cases, are they seeing the people that want to go the bridge to permanent? It's because they're trying to hold that property either in the rental portfolio, or they're not confident on the timing to sell that property, or why would somebody go the bridge to permanent as opposed to just going hard money straight up to build and sell?
Yeah, a common strategy that we see, and I think that's become pretty popular especially if you listen to this podcast, I imagine you probably listen to Bigger Pockets and some of those other guys, is the BRRRR method. So for those of you who are listening who don't know what the BRRRR method is, BRRRR stands for buy, rehab, rent, refinance, repeat. So without giving numbers and going through all the math, you're buying it at a low price because it's distressed.
Sure.
You're renovating it to bring it up to the market value, to be in line with other renovated properties that are in that neighborhood. You're renting the property out for more than what the payment will be once it's refinanced.
Right, from the bridge to the permanent.
Yeah, and in a perfect world, some people will say a perfect BRRRR, you're refinancing out your initial down payment based on the new value, and that's predicated on the fact that this new payment in this second loan, there's two separate loans here, in this second loan covers or is covered by the rent.
Right.
And then repeat is, hey, I just got my down payment from the first deal back. I'm going to do it again.
Yeah, absolutely. Which has been tougher for people to do that method given where interest rates are.
Yeah, well, two things there, right? So it's tough for two reasons. The first is what you just said. Absolutely. Higher rates, right? The second part of that equation is based on this new loan. If the new loan's got a higher rate, it's got an 8 handle on it or a 7 handle, like, yeah, of course it's harder.
Right.
So you gotta buy even deeper, right? And you have to make sure that on the front end that you're doing all the math to go through that. And that's part of what we're looking for as being a partner is like, well, let's flesh this idea out.
How good is your due diligence?
Exactly. And there's assumptions that some people miss, and it's not because people are dumb or they don't know or they're ignorant. It's some of these things they don't realize. Let's pretend you're an investor from Connecticut, and you move down here, and you don't know how property taxes work in Florida. Yeah. It's like, well, hey, like, talk to me. Like, I can tell you about how the reassessment works, and I can tell you what I think it'll be, and
that's going to factor in.
You need to factor that in.
You're renting it out.
Yeah, you don't want to be a year down the road, the taxes reassess, and it's like, wow, the $200 a month margin you had is now eaten up.
Yep.
And now you're just owning it to own it.
Yep.
Like,
not to mention
what fun
insurance increases and all the other fun stuff. Water heater goes out. Somebody busts a window. Yeah. Whatever the case is.
Exactly.
No,
exactly.
That's so.
Oh, sorry. And one thing I was going to say on the BRRRRs is so a common thing that you'll run into, because I know you brought up the banks a couple times. So one thing that I see a lot with banks, a common thing, not every bank, a common thing with banks is that they will require a greater seasoning period. So for those of you listening who don't know what seasoning period is, it refers to when a lender will count a new value, right? So if you think about, you bought it for $200, it's worth $400 now because you renovated it and made it nice for whatever you did. Somebody looking at this going, well, hold on a second, this guy just bought this 4 months ago for $200. Why is it worth $400 now? Yep. It's like, well, yeah, you renovated it. Yeah, but like,
is it really?
Yeah.
Yeah, perceived value or market value?
Correct. And listen, like, it to a lot of investors, it doesn't always make sense because they're going, well, I could just sell this thing for $400. And the answer is yes, you could. Yeah. You're absolutely right, you could. And sometimes maybe that makes more sense. Now, lenders have different seasoning requirements, as do we. Like, our seasoning is different based on who the person is. But a common thing with banks is they'll say, yeah, we need a year seasoning. Yeah. Or even after a year, we're still at 65 loan to cost. Yeah. And what that means is they'll only refinance up to 65% of your basis, what you bought it for and what you renovated it, not your interest carry most times. And that's the limit. Well, if that's the criteria, trust me, you're not repeating anything.
Right, exactly.
Yeah.
That's a really good point. And that's something that people need to, if they're not working with you, or whoever they're working with, make sure they're clear on that point. Because that's huge. Because the whole point, I would say arguably the cornerstone of the BRRRR method is the perceived value coming from an appraiser, right? Because sometimes perceived value could be much greater than what you can actually sell it for, right? Sometimes it could be inverse, right, which we saw with low interest rates in the COVID period where people were paying above and beyond appraised value for something.
Correct.
So technically, what's market value? What somebody's willing to pay, right? Or the appraisal. It technically is what somebody's willing to pay, but obviously...
And all the comps are thrown off in the area because people are paying $100,000 over asking.
Exactly.
Or whatever it is, right?
So when you do, last question on the bridge loan. So are we rolling in the closing cost on that second loan to the loan, or is that paid separately?
Depends.
Okay. That's a big thing for people. People don't realize when you close a loan, you're paying closing costs each time.
Yeah. And by the way, every lender you'll talk to, their favorite word is depends, because it's true. Well, it depends on the situation.
Yeah, maybe.
Other lenders that are watching this going, yeah, that's true. The amount that you can pull out is based on, is it a cash out refinance? Sure. To your point earlier about rates being higher, and it makes it more difficult. I have seen cash-in refinances. That's a thing, right? And for those of you who are like, what's a cash-in refinance? It's exactly what it sounds like. You're bringing cash into the deal to keep the asset. Right. We get the main criteria for the second loan. The first loan is, hey, I'm rehabbing it and it's worth this when it's finished. The criteria for the second loan is does my rent roll cover my payment? And if the answer is no, or it's not enough based on whatever the asset is, right? Multifamily, you need more cash flow than you do a single family, for example. If the answer is no, you have to bring money in to make that work. So no, you're not rolling in any closing costs. Now, if you're getting money out, then before you get the money out, you're getting the points and fees and all that covered.
Well, that's important for people to know, especially if they're trying to do the burn method, where the cash flow on that rent roll is going to be very pertinent.
Exactly.
And then if you're paying an extra, let's just call it for easy math, $10,000 for. This is, again, might be less, but $10,000 in closing costs on twice. That's $20,000 that you have in on simply just closing costs. That has to be factored in.
Right. And what are the title fees? What are the insurance escrows? What are the tax escrows? You might not be on with your numbers as you think you are, and unless you've done this a bunch of times in the same area, I would encourage someone to get a second set of eyes on it, whether it's me or somebody else.
Yeah, absolutely. Especially if you're leveraging. I think the big thing too is they see other people do this method, not understanding that not every bird deal is done leveraging the bank's money. Sometimes they have so much cash on hand that they're doing the same method, but they're using their own money.
Yes.
So they're saving all those financing costs, if you will.
Right, yeah, you didn't pay for the first loan. I've seen that. I've seen plenty of those where they say, I have enough money to do the purchase and renovation with my own cash, but I do want to pull the money back out on the back end so that I can continue to do this. And I would like to take long-term debt, but I just don't need the short-term. We see plenty of that.
Absolutely. We talked a little bit about the speed is pretty quick at Renovo so how quick is the pre-approval process to figure out if you're a good candidate to work with, because obviously that's huge, right? You find a property you want to move on. Can I even get the financing? So how quick can we kind of do due diligence when they work with you on that?
I think a lot of it again is it's really all about fit and making sure that we are a good fit to work together. And I think certain people go into things with a certain expectation and to what we talked about early on in the conversation was, what's the relationship? And is there a relationship here for both of us that is going to benefit us and benefit you and your business? And if there is, then we should move forward. Moving forward after an initial conversation and getting to know each other in a setting like this, maybe it's not in a podcast studio, would be to do an application.
Sure.
On our end, we have a one-time app. It's good for a year, and that is the criteria to get pre-approved, is filling that out. And then from there, if you need a proof of funds letter or you need me to talk to an agent because they want to make sure that you're real and that you actually are pre-qualified, that's part of what we're offering. So that's the first step.
Gotcha. So what kind of advice would you give to investors to alleviate potential red flags when it comes to, I know obviously fit is huge, but what are things they can be doing now to put themselves in a good situation? Is it similar to what you would do for a traditional loan? Just obviously make sure you have a good credit score, make sure you're limiting your debt if you plan on investing in the next 6 months. What are some things that might come off as red flags? Is it simply the amount of reserves that you have? Is it the credit card debt? I mean, what are some things that they're a great fit, but this one thing disqualifies them?
I think a lot of the things you said are totally valid there, right? A misconception is, it's hard money, therefore I'm on this end of the spectrum. You don't need any of that stuff.
Right.
And if that's...
Depends on the lender, right? Yeah.
If that's what you want, then you should go work with a lender like that. Those guys are out there. There's plenty of them in town. I could give you a few of their names if you want to reach out to me after the podcast. I can hook you up with them. No big deal. We do ask for a little bit more information. And to your point, to get yourself set up, have good cash reserves. You should have low debt, right? Why should you have low debt? No, we're not looking at debt to income.
Right.
But we are looking at what is the financial picture.
Right. How are you, if you can't manage your personal cash flow, how can you manage a business cash flow or investment cash flow?
I'll give you a scenario, a fictitious scenario where, you run someone's credit. The guy's got one mortgage. He's got 3 car payments, a boat payment, and credit card payments that total up minimum. The minimum monthly payments on the credit report total up to $2,000 a month.
Sure.
Just in the credit cards, never mind the boat and the 3 cars and the mortgage.
Right.
And the guy has X in reserves. Well, how many months of survival there? Never mind this new deal that we're talking about. How many months of survival do you have there?
Right.
I mean, I don't know. To me, that's relevant.
Yeah.
Right? How are you living?
Yeah.
So, I do think that stuff applies. I mean, the way that we underwrite is different than the bank, but I do think that the stuff is applicable, and I think those are just good financial principles. You should be encouraged to pay down debts and build up your own reserves. I mean, what you're looking to do is start a business, and before you can start a business, you should probably show that on your own you're financially stable.
Yeah, I mean, I think it goes with other things too. It's like, you want that Rolex watch, but can you afford that Rolex watch? No, I can't. Well, it's like, maybe you should make sure you can afford it, or not use your money for dinner to buy the whatever the case is.
Right, or slow down on the trips, slow down on the recreational activities, the boat, the motorcycle, the this. It's like, man, all that stuff's fun, but have your priorities in order first, and show us that you'd be a good person to lend to.
Yeah, no, I think that's a big thing.
Mm-hmm. And to put the cherry on top on that, a common thing you'll see, and we were talking about them earlier, but the gurus, right? A lot of the gurus will give you the whole pitch of like OPM, OPM. And for those of you who are listening who don't know what that is, OPM stands for other people's money. Mm-hmm. So, they're encouraging you to go out and get other people's money to do a deal, but if you've never done a deal, like, that's incredibly risky.
Yeah.
People that we see that are using other people's money have a proven track record. And when I say proven, I mean more than a year.
Sure.
Several years.
Yeah, I was going to say too, it's some of those, most of the time when there's a restriction, whether it's a price restriction like the Rolex example, or it's restrictions for lending, whatever, those are there to protect you from yourself. Right? And I would argue that other people's money is applicable for growth as opposed to getting started.
That's a great way to say it.
And so, I think in golf, you go buy used clubs before you buy the new clubs, right? It's like, let's make sure I love playing golf, or even can hit the ball before I go spend, $1,500 on new clubs.
Right. Maybe you rent first, and then you buy used, and then you buy new.
You go to the driving range, you go to Top Golf, whatever. It's like, I'm here for the day, $30, whatever the case is. But no, I think a lot of things are protecting us from ourselves, especially when we're just starting and we don't know what to be, we don't know how to drive defensive yet, right? So it's like, all we do is we have our driver's license, but we've never been on the road, on the highway, and rush hour, it's snowing, it's whatever, right? So I think those things are super important, and just kind of keep you safe.
Absolutely.
From yourself.
That's the intent, right? It's not to be this elitist institution. That's not the intent at all. The intent is to make sure that everybody wins.
Mm-hmm. Absolutely.
Right.
So what about, I guess we kind of talked about it already, but I guess we'll pivot. Is there any personal investments that you're interested in? I know you're obviously a lot of people that are in the industry, I would say more than half of them never step out and do their own investments. They could be lifelong bankers, lifelong appraisers, real estate agents, which is crazy to me. They're selling so many houses outside of their personal house. They never really step out there. So do you have any aspirations to either grow a rental portfolio or do some of your own developments, just because you kind of see under the hood and you kind of see how things are connected?
Yeah. To your point, and to I believe the name of this podcast is Life in Focus.
Yeah.
I live and breathe this job.
Yeah.
I wake up and I think about making loans, and I go to sleep thinking about making loans. And I know that probably sounds cheesy. They're like, wow, this guy's corny as hell. And but that's the legitimate truth.
Absolutely. It's a lifestyle once you're embedded in it.
It is a lifestyle. And one of the key, is part of my growth over the last 5 years of being in this business and helping fund however many hundreds of millions in loans. Yeah. You would think like this guy's got to have done a handful of rehabs himself, or I'm sure he owns a few rental properties.
Sure.
I own zero real estate.
Mm-hmm. Yeah.
I owned a house with my fiance in Carrollwood in Tampa. We sold it in September, so now I own no real estate. I rent an apartment. I'm okay with that.
Yeah.
I think that there's a lot of value in what I do, and I think eventually, I'm sure there will be some sort of investment of some kind. I'm really interested in multifamily. I think that that's a really interesting business, and I think that there's a lot of power in economies of scale, and I think someday down the road I might venture into that. But I'm a big believer in practicing what I preach.
Yeah.
I keep,
opportunity cost too.
I keep more cash on hand than most people do. I'd rather be able to weather a storm.
Sure.
And maybe to a fault, but someday I think I'll jump in. But for now, I'm hyper focused on building this lending business within Renovo, and helping them grow the Tampa Bay area, and down to Naples, and seeing that be really successful before focusing on other things.
Yeah, absolutely. So the goal would be to have you on at least once a year, maybe twice a year, just talk about current deals, what you're doing. Obviously things change all the time in this industry, but let's just say this time next year, what do you want to have accomplished in regards to what you've either brought to Renovo or where you brought Renovo to? Just from like we go into each year with
goals.
These annual goals and stuff like that. But sometimes people go in with one goal, sometimes we have 10, but when you look back at every year, you should have at least one thing like, 2024 was this year, we did this, or 2023, or COVID was 2020, we got through that.
Right.
So for 2025, what do you want? It might change, changes every day, but what's like the macro thing that
I'll kind of take you through some of my journey at Renovo to answer that. Like 2022 is like, hey, build the business, right? Yeah. Focus solely on lending to people in the Tampa Bay area. And that a lot of that meant like telling certain people that I was working with, like, hey, I'm now doing this new thing, and I'm focused on people who are investing in this area of the country. So that was 2022. So I started in July. That was the first part of it. 2023 was like the year of getting my own team. So part of how we help make the experience for clients, I was talking a lot about the post-close experience, right, with the draws and the servicing. Part of what we do to make the pre-close experience really awesome is making sure that people are feeling paid attention to throughout the process.
Sure.
And the way that we do that is, I bring people in the door, but then we've effectively built this like assembly line of loans. And the way that we do that is with the 3 positions that are on what we call a pod. So a pod is a production assistant, a credit analyst, and a loan closer. So the production assistant, her name's Erica. Hi, Erica, if you're watching. Hey. Erica's job is to bring clients in and help with applications as needed and she'll gather like an initial needs list. And then it goes to Gio. Gio's my credit analyst. He's been working in lending, and he actually came from PNC Bank doing multifamily underwriting. Okay. And now he underwrites the deals and puts them together in a summary and presents them to our credit team to get approved. And then lastly is my closer, Michelle. Michelle's been with me the longest. And Michelle's job is to work with the title agent and the insurance agent to make sure that we have what we need to get the loan closed. We kind of all work as a cohesive unit. Yeah. When you're new at Renovo, you share these people with others.
Gotcha.
But in order to get to a certain point of growth, you need to get your own team.
Have enough business to support that team.
Correct.
That unit.
Yeah, there's a financial investment on my end to have them. And so in order to get to that point, so the end of 2023, I was getting these people. And Michelle has been with me the whole time. But, first we hired Gio in actually December. Yeah, we just hit his 1 year. And then January, Erica came onto the team. So now we've basically been like a year together. So this is the first part. So, but when you get these people, like we're all like learning to work together, and by learning to work together, what I really mean is me learning to get the hell out of their way.
Yeah.
I'm so good at that.
How can I support them?
How can I support them? Yeah, but we've done a lot of, and I'm maybe sharing too much. I don't know, but a lot of what we've learned is like, I need to let them do them, and they're great at what they do, and I need to stay out of the way. So a lot of what we've been doing over this year is refining processes and getting better as a team. And we do stuff outside of work. We're going to an event. I don't know when this podcast is being released. When is this coming out?
This will come out the first of the year.
Oh, okay. So next week there's a big real estate meetup, a quarterly meetup called the Elite Investor Meetup Group. It's in Hyde Park in Tampa. And that's quarterly. We're one of the main sponsors for that event. And for that, all of us go. And everyone gets a chance to meet my team and gets to see the people that they're working with. Yeah, I think so. And people like putting a face to the name. It's like a lot of people have exchanged emails with Erica and Michelle, and they think they're friendly ladies, but they're like, oh wow, you're a real person.
Yeah,
so
it makes a big difference.
Yeah, it is. So
for the personal touch, like you were saying, especially if it's a long-term relationship, it's like, hey, I know I'm working with you, but I'm working with your team as well. So I love to, you said, put a face to the name type.
Exactly. Thing, so to kind of put a closing thought on that, 2025, like the goal is to like continue to grow the business, and like maybe we add a couple other people to the team to help us, that really to help me leverage my time and continue to go out there and meet with more people, and not just new people but like existing people too. Like I want you to feel like we have a relationship, and it's not like, oh sure, he picks up. It's like, no, he walked my project, like it came out, like and that's part of what we do. Like I come to people's projects all the time. We grab lunch. Like it is a relationship.
Yeah, no, absolutely. And like you said, it goes a long way for both sides. Obviously, as the client, you feel like you're respected. That person actually cares about your deal, and as for you, it's a continuous vet of that relationship, right?
Yeah,
the relationship could be good, but it could turn sour for like, hey, this guy's clearly has something going on personally because he's not the same business guy as he was, whatever the case is, but it's just a continuous vet. So
sure, yeah, it's a mutual vet, right?
Mutual vet, yeah. So.
And we want to make people feel like we're really supporting their business, and I think that's what we do.
Absolutely. So. Well, I appreciate you taking the time to come on, man, and share a few some details and insights. And like I said, we'll have you on again. And this first episode, I wanted to just kind of introduce you and kind of introduce Renovo and what they can do. And obviously, a big part of this podcast was to kind of tie in different real estate stuff with the community, stuff that I'm doing, stuff that the guests are doing in the community.
I appreciate that.
Yeah, absolutely. And so we'll get into some more of the nook and crannies next time and more specific deals. And as I get feedback from listeners, we'll talk about things that they have questions on and stuff like that.
Awesome.
But once again, appreciate you coming on, man.
Yeah.
And looking forward to 2025.
Great. Thanks, man. You too.
Yeah, man. Absolutely.